The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, good evening to you. Warren is a director at Galileo Capital. He's a personal financial advisor. I got an email today from Robert. I don't know if you saw the email. I did forward it to you. I'm hoping not catching you on the back foot here. He's talking about money market type funds versus unit trusts and others, and the way in which returns are compounded. Now, compounding is powerful, and we're going to talk about compounding in just a bit when it comes to dividends. But Robert says your money market type funds are giving between 6.5% and 7.5% compound interest daily, weekly, monthly, etc. Unit trusts, on the other hand, don't provide compounding interest, but rather at certain times, dependent on unit trust distributions of interest and dividends at certain periods. Let's say per year, on average, balanced unit trusts and income funds give between 8 and 10% growth. The question is, where does one actually make the most growth when it comes from compounding? Do you want your money to be compounding daily, weekly, or monthly? How does it work, Warren?
It's actually a brilliant question because it points to the confusion created by product providers. These are the banks and the unit trust companies, because you'll often see an advert that says, get up to 11.25%. Yeah, and then there's a little star next to that, and then you go and read it, and it says, that percentage is only valid if you invest, lots of money and you leave it invested for 5 years. Then the compound annual growth rate or the effective annual rate will be 14%. But if you go and work it out backwards and you say, well, what will I get if I only leave the money in for 3 years and not the 5 years? And then all of a sudden it's not 14%, it's something less. And so the confusion kicks in with firstly the exact time period that you're investing the money, and then also what is the rate that you're being quoted? Is it the nominal interest rate or the compounding rate? So is it the actual effective rate? So just to explain that very quickly, if I have, I'm liking Robert's examples. I did a bit of calculations myself. So I said, well, take 100,000 rand, and I'm going to earn 7% a year on a money market investment. And if it's just 7% interest, not compounding or anything, then I'm going to get at the end of the year, I'm going to have 7% on 100,000 rand. In other words, 107,000 rand. That's the number I'm going to get. And so if you had a compounding rate, it would be a slightly different thing, because what would then happen is you would say, well, you're earning some money after day one, and it will earn a little bit of interest. And if you had to calculate that interest, which I'm not going to do now, but it would be, the 7,000 rand divided by 365 days, and then you add that to the initial investment that you made, and then you would earn 7% on the 100,000 rand plus a tiny little an extra few cents, and so that amount starts to compound, and so at the end of the year you won't have 107,000 rand, you'll have a little bit more than 107,000 rand. So the answer is that you would like an investment to compound as frequently as possible. The reality is that there are going to be very few investments that will compound daily. So what they'll usually do is they'll say to you, it will compound, most of the time it'll be compounded monthly. And so we're talking about a slight improvement. But I think to one point, Robert, it's not a massive difference. So if someone says to you, I'm going to compound your investment daily, or I'm going to compound it monthly, the most important thing is what is the actual kind of benchmark interest rate that they're compounding on? Is it 7% or is it 10%? Because that makes a huge difference. Compounding daily or monthly over even a 5-year period, it's going to work out to maybe 0.025% difference in your growth, one way or the other. So the truth is, you want to focus on the main number, the 6.5% or 7%, and then focus on that. The way that unit trusts report, I think, just be careful, because unit trusts distribute the income that they've generated on an infrequent basis. And as he says, and he's right, money market funds might do that monthly or quarterly, and then other funds, income funds, might only do it every 6 months or every year. That doesn't mean that they're not compounding the money inside the unit trust while it's growing. So the one is about a distribution. In other words, it's a mechanical thing. When will they pay out that interest that you're earning? And the more important thing is, how is it growing? And he points it out in his question, which is great. He's saying, well, it could be somewhere around 8 or 10%, and that's the bigger number. So the reality is, don't focus on the daily compounding, etc. Look at who's offering the best rate of interest. The bank account might give you a guaranteed rate. The bank might say, we actually guarantee an interest rate of 7% for the next year, whereas the income unit trust or the money market unit trust can only show you what the interest was over the last 12 months. And they can say, well, we show an indicative yield. In other words, this is what we believe the current amount of money is generating as interest, and the indicative yield might be 8%. But that is not a guarantee. So going for slightly more interest and aiming for a bit more growth on your money via the unit trust, especially once you go from a money market unit trust to an income fund, you are taking on slightly more risk, really the risk that the interest doesn't get paid or that it's less than you hoped, whereas the bank account might be much more certain. So depending on how much you value certainty over growth, you can make the call. To me, I'm generally going to default to the unit trust, that pays a bit more interest. They have a very good history of doing it. I think only in the time when African Bank hit the wall was the only time I can recall South African money market funds not paying the interest that they were planning to pay out.
Got you on that one. Thank you. And I hope, Robert, that helps you, because it's a great question, and it's a really important issue to understand. Thank you for your question, Robert. On to another one, and this is a compounding of a different kind.
Can we stop, Bruce, and can we just get on our soap? Can I get on my soapbox?
Oh, you get on your soapbox. Hold on. Let me just get out the way. Oh. Right, there we go.
Let me stretch. So the question is a valid and brilliant question. It also points out that we're allowing these banks and product providers, and I'm going across the money markets, all of them, to kind of confuse the issue when it can be really simple. I mean, there should just be one number. If you invest your money for 5 years, they can just set a standard. The compound annual growth rate will be X, or the effective annual interest rate will be X, and not in, with the little asterisks and then right in the fine print. That's absolute nonsense. It's misleading stuff. Please don't do it. Treat us like adults. We're trusting you with our money. Why don't you trust us with valid information? I'm off my soapbox.
No. Stay on the soapbox, because it goes to, what does an investment actually cost? And that is the other one, where there have been efforts over the years to try and clarify the real costs of investment, but it's just like the number of descriptors and the number of obfuscations in the process of saying this is what your investment actually costs you is also one that beggars belief.
Okay, I'm busy rolling up my sleeves now. Yes, and I think there are double standards as well when it comes to this, because you look at the unit trust industry. The reason that the unit trust industry, now decades ago started and became very powerful was because there was a huge amount of frustration on behalf of many of us with the insurance companies and their investments, and the absolute opaque nature of the way they charged and the way they invested and actually how they calculated returns. And so the unit trust industry came about promising a level of transparency which we had never seen before. And that certainly was the case. But then everybody entered that industry. More practitioners came in and wanted a leg up and in a way, kind of an advantage over their competitors. So they started to fudge the numbers. And then, they kept on setting standards. And, at first it was, I can't even remember. It's so boring now because it's been such a long, drawn out story. But we're kind of right now with total investment charge. That's the one that, you would say, okay, so is that all the costs? Well, it's most of the costs, sir. It's actually not really all the costs. And then when you look at the insurance companies, they adapt and they'll say, hang on, if you look at the product that we're selling you today, yes, it's really expensive if you buy it and you look at it over 1 year, it's going to cost you, 5.5%. But if you stay invested for the next 5 years, by the fifth year, it's only going to cost you 3.3%. And so the way they're framing you, because this is really what they're doing, it's using psychology against you, is they're showing you how this investment is, rapidly declining in fees. So you feel like you're getting a great deal if you stay invested for 5 years. Whereas if you look at the fifth year costs of 3.3%, and then you go and look at, bog standard index tracking unit trust or exchange traded fund, which only costs you 0.4%, that's the benchmark. That's what they should be saying is, we're charging you 3.3, you can get 4.4%. We are 2.5% more expensive than anybody else, or nearly 3% more expensive than anybody else. This is the reason why we're more expensive. That would be transparency. That they won't like that, of course, so they're not going to do it.
Yeah. Okay. Let's get off the soapbox. Down. And talk about another form of compounding. The power of dividends. A dividend is, very simply put, a share of profits. At the end of the year, company has got extra money, and it's got a couple of things it could do with it. It could invest in growth. It could, it might take a bit of the money and go and invest in new growth opportunities. But investors like to get a dividend. They like to be paid some money from the company in which they're invested. What is the power and the purpose of that dividend in your hands, Warren?
So let's imagine you and I decided 30 years ago that we were going to just do something really basic. We were each going to take some money. We were going to put it into something really simple like the stock market index. And then on the application form to buy this investment, because it's 30 years ago, there was no such thing as online trading. You ticked the box because you were well informed that said, any dividends I earn, just reinvest them in the same index. I wasn't so well informed, so I just said, well, I'll take those dividends. Thank you very much. I'm going to go and spend them, but leave my money here for the same time period as you. 30 years later, the amount of money you've got is nearly double the amount of money I've got. And all you did was you ticked a box that I didn't tick. The box you ticked was take those dividends, buy exactly the same index, which is then just the exact same basket of shares that Warren's got, but just keep buying them no matter what, as soon as I've got cash available from the dividends that those shares are paying. And you get the double the return, I get half. So how do we explain that? And it's about those shares that you own being bought in every single market condition there is over the last 30 years. And it's about buying, for example, when those dividends come out and the stock market's falling and the headlines are terrible, you're not worrying about that because you just ticked one box and automatically those dividends are being reinvested in those self-same companies and often at a really low price. And so you carry on. And when the economies are booming and those companies are making lots of profits, they're generating a lot more dividends. And so there is more cash to buy more shares. And so things just keep going. And that's the power of something, this compounding that you're talking about. And that can only happen if you constantly reinvest the dividends all the time. And that's the mistake that a lot of investors make with investing in shares is that they...
And we're talking serious money here. I mean, I've got some figures here that suggest that if you'd invested $10,000 in the S&P 500, which is the best sort of benchmark of American companies and investments. If you've done it over a 30-year period, so from the year before the democratic election of South Africa, of the ANC to run South Africa, if you'd bought $10,000 worth of S&P 500 and you'd left it there till today, now on the basis of your investment, you would have $88,000 sitting in your investment account, which is a fair chunk of change. I, however, out of my $10,000, because I'd reinvested dividends over 30 years, I don't know why you didn't tell me this 30 years ago, I would have $154,000, literally twice as much as you. And that is through doing absolutely nothing, by simply putting $10,000 into an investment, leaving it to molder away through 9/11, through Iraq war after Iraq war, the global financial crisis, the COVID meltdown, all of that stuff, $10,000 has become $154,000 by ticking the invest the dividends box.
You're absolutely right. And just for a little piece of additional context, it also included that little thing which doesn't seem so big anymore, which was the IT bubble bursting,
Yes.
which caused the S&P 500 to do absolutely nothing for an entire decade. Investors made no money for 10 years out of this 30-year period, and you still doubled your money. And so it is a really powerful thing to do. And I think the reason why I'm so keen to talk about it now is because we're in an extremely volatile time right around the world. You know, there are lots of reasons to be deeply fearful about economies and, you know, our economy, what's going to happen to our economy with load shedding, et cetera, et cetera. You know, globally, you know, interest rates are high, inflation rates are high. We don't know what's happening in the Ukraine. You know, we don't know how, China's sorting itself out. Lots of great reasons to be quite worried. And the message here is there were lots of great reasons all along in the last 30 years to be really worried and you know, not worrying about it, not thinking about it, and just, you know, staying invested and reinvesting the dividends time and time again was an enormously powerful thing to do for your personal kind of financial freedom. And I'm absolutely convinced that the same thing repeats itself for the next 30 years. And that's the point here, is don't worry about what's going on and why we're being told to be afraid. We're always being told to be afraid. Every 1 or 3 or 5 or 7 years, something's happening. There's some prognosticator that, you know, usually comes, you know, from a huge bank or a huge asset manager, seems deeply credible, telling you that the world's going to end again. And so the temptation then is to say, well, maybe I should just sell the shares I've got, or, gee, I got some dividends and maybe I'm not going to invest those now because I'm really worried that the economy is going to go into recession and these businesses are not going to do well. Well, don't do that. The behavioral punishment there is you lose half of the growth that you can get. Yeah. And so that half of the growth is probably the difference between a great kind of financial freedom life or an average one. And
I don't want to do this calculation because it's going to upset me too much. But imagine if you'd taken that initial $10,000 and you'd done the ticking the box of the dividend, and you'd reinvest your dividends, and your 10,000 grew 15 times to $154,000. But imagine over that same period of time, every month you just had a debit order for $100 going to the same investment with the same little box ticked. And you would have seen. I'm not doing that calculation. It's upsetting me too much. Just even thinking about it. What I can tell you is I saw a tweet today out of the United States saying that Michigan, the U.S. state of Michigan, has become the 14th state in the United States to mandate personal finance education before high school graduation. A quote here from the Michigan governor, I suppose. Every young Michiganer deserves to know how to budget, save, and invest their money wisely so they can get off to a great start after high school, where they go to college, start working, or open a small business. The law will go into effect for students starting 8th grade in the 23-24 school year. 14 states in the United States, mandatory personal finance education. Teaching the sort of stuff that we're talking about this evening. It's critical, isn't it?
I mean, I've got such a nice solution for them. Surely, there's this thing called the Personal Finance Podcast on the Money Show, and we should just send it to them, and they can just go back on all the shows we've done, and they've got a syllabus set up for themselves and explained very nicely. And yes, they are Americans, so we can maybe just slow down the speed a little bit for them. They'll get it, and.
We were doing so well. We had a business up until that moment. We had a business. Quick question from Ilza. Ilza's got a problem that we all wish we had. We don't wish ill on anybody, but we all wish there was an aunt we'd never heard of who died. And so it would be very sad that this person had died, but we didn't know them, so it doesn't upset us. Ilza has received an inheritance from an aunt overseas, currently sitting in pounds in a bank account. Should I leave it in cash for now and wait till markets pick up? Don't swear at Ilza, Warren.
Firstly, Ilza, I won't swear at you, but I am going to say to you that the best favor I can give you is please make sure you just speak to a tax person, because you are 100% allowed and entitled to earn an inheritance from overseas. But you can't just not tell anybody, especially at our friends at SARS. They need to know that this is now something that you own, and that in the future you'll be paying them some tax on the interest or growth or dividends that you're earning from that investment. So first thing is, the authorities in SA do need to know about this, and just get some tax advice about how you need to do that. In terms of the second part, do you leave it in cash? I think it's nice to see interest rates rising overseas if you're a cash investor, and it feels very comforting when you were earning nothing on your pounds a couple of months ago, and suddenly you're earning a few percent, and it's nice to see that going up every now and then. The truth is that the stock market is really cheap all around the world. All of the valuations of global markets, South Africa included, but developed markets as well, those markets are all trading below their fair value. In other words, the big for sale sign, Black Friday, is happening in the stock market right now, and you really should not be sitting on the sidelines with cash, just earning that comforting bit of interest, because you're missing out on the next decades of growth that could change your life fundamentally with the inheritance you've got. So I think if you want to change your life for the better, then do yourself a favor, start investing. Don't put it all in one shot. Take 6 months if you're a little bit cautious, or even longer. Take 12 months, but invest that money into the stock markets. Don't be clever about it. Just the world market is absolutely fine. Buy an index if you need to, and invest it. You won't be sorry in 30 years' time. You can send me and Bruce a thank you card.
To the Shady Pines Retirement Home. Send spare teeth and soft marshmallows as well. Warren Ingram from Galileo Capital, thank you very, very much indeed. Warren, personal financial advisor, director at Galileo Capital. Fabulous contribution as always. Wonderful insights into the world of money. Lots to learn this evening here on The Money Show.